Welcome back. You're watching MF Corner, and it's time now to answer the queries which have been sent in by our viewers. Joining in is Shweta Rajani of Anand Rathi Private Wealth Management. Hi, Shweta. Good afternoon. Thanks for joining in. And the first query itself is very interesting. You know, we have Mayank writing to us on Twitter, and his question is that if somebody wants to invest in floater rate funds, then should modified duration be looked at or not? If yes, then is a higher duration good or lower? But Shweta, before I toss it to you, I want to just quickly explain this concept of the floater rate funds to our viewers. Basically, these are a category of debt mutual funds where the minimum 80% investment by these funds must be made in floating rate instruments, right? So that's what Mayank is talking about. Now, Shweta, should he be looking at modified duration? And what is good, a higher duration or a lower one?
Sure. So the first thing is that whether an instrument is a floating rate instrument or a fixed interest rate bearing instrument, it is sensitive to interest rate movement. The sensitivity is an inverse relation, which means if the interest rates move up, the price of the bond or the fund would fall. And by what quantum would your price change with respect to the interest rate movement is measured by modified duration. So point one, yes, it is important to look at duration even if you are investing in a floater rate fund. And a higher modified duration indicates that the fund would have more volatility on account of rate movements. So generally, a higher modified duration fund should be avoided.
Okay. The next query comes in from Aslam Syed, who's written to us. In fact, he sent us an email. Now, what he says is that he invested in the IDBI education bonds about 25 years ago. So he put in 20,000 rupees about 25 years ago. Now he says he's getting back only 29,000. Shweta, I understand these are limited time bonds that were issued. What does he do now?
Yes. So these are bonds which were a part of the Flexi series of IDBI and were issued in 1998. There were three structures to it. The first structure had a wait period of 5 years, which means from 98 to 2003, the bond would not pay out anything. And for the next 5 years, 2003 to 2007, the bond would pay out 2,450 rupees, of which 1,000 is the principal component and residual is the interest component. And this payout was made on an annual basis. The bond matured in 2005, and after that, there's been no interest accrual on this. So if you've invested in this bond, you would have received your interest warrants on a regular basis, and post 2005, it's not accruing interest. Second, the other structure was again a 7-year wait period, which means from 1998 till 2005, the bond would not pay anything. And for the next few years, it would pay out a 3,200 annual payment. This again included 1,000 of principal and balance as interest. And after 2009, the interest accrual on this also stopped because the bonds matured. And you would have received your annual interest warrants on this. Because from the date of maturity till today, there's been no interest accrual. Your 20,000 has grown to the maturity value of 29,000. And it stands at that.
Okay, so this is 29,000 per bond that they have bought, like basically 29 into 2, or is it 29,000 per se?
29,000 per se. So it would be, the face value was 5,000. So these are 4 bonds if you've invested 20,000.
Okay.
Value of this 20,000 is 29,000 today.
Okay.
Because you also received interest accruals.
Got it.
2003 to 7.
Okay, Venkat A has written from Chennai. He says he's a long-term investor with a moderate risk appetite. He has invested in multiple funds, a few between 5 to 7 years ago. And he has also shortlisted some funds. So, the shortlisted ones are basically ICICI Advantage, Asset Allocator, the Kotak Standard Multicap, etc. He wants a view now on what his portfolio could possibly look like, whether he should make some changes. And, Shweta, he has this whole list of funds, and perhaps we should just start flashing because it is a long list. I mean, first up, I'm supposing you're going to advise that he needs to prune down the number of funds that he has.
Right. So first, of course, is you need to, not spread out your portfolio too much. You need to have ideally, 7 to 8 funds in your portfolio. That will give you enough diversification that you would need. Secondly, the funds that you've mentioned, some of them are pure equity funds, some of them are, hybrid-oriented funds, which basically invest in a mix of both equity and debt, depending on the current market situation. So the first thing that you need to do is, asset allocation is important, and that's the first decision you should take when you are doing your financial, deciding your objectives. So decide your asset allocation at your overall wealth level, and once you've decided that, separately park your money in equity funds and in pure debt funds. That will help you when you are doing your performance track. Also, some of the hybrid funds that you have a higher equity allocation to the extent of 80-85% compared to the other hybrid funds like an iPru Balance or a Canara or diverse hybrid or which is why also your funds have you notice underperformance in your hybrid funds. So point one, decide your asset allocation at a portfolio level. Point two, once you've decided that, separately in pure equity and pure debt funds. Equity funds, consider, yes, Kotak Standard Multicap is a good fund. You can hold on to that. You can look at, a Mirai Large Cap Fund, Kotak Emerging Fund, SBI. Similarly, on the debt side, you can look at funds like HDFC, PSU, SBI Medium Duration, iPru, All Season Fund. So that's, ideally the portfolio you should have.
Okay, I believe we have Mr. Venkat on the line with us. Mr. Venkat, my apologies. I didn't hear. Did you get the answer that Shweta gave? Are you satisfied? Do you have any more queries?
Yes, see, my basic query is regarding two funds. I mean, one is the Aditya Birla Hybrid 95 Fund and the HDFC Balanced Advantage Fund. Both these funds of late have not been doing well. I mean, they have done well over the past 5-7 years, but of late it's not been doing well. So should I continue to hold these funds, or can I switch to some more popular funds of late like ICICI Prudential Balanced Advantage Fund or ICICI Asset Allocator Fund? Or are there any other funds within the same fund house of HDFC and Birla which I can switch these two mutual fund holdings if they are not worth holding? That was my specific query. Yeah.
Okay. So basically, Shweta has listed out a number of mutual funds that you could look at. But Shweta, in terms of switching out itself, is that recommended?
Yes. Hello, Mr. Venkat. My recommendation would be that you switch out of these funds. They have been underperforming the peer category for quite some time now. So you switch out of these funds into, like an HDFC banking and PSU debt fund, maybe for your debt option. Clearly, I think you mentioned Aditya Birla. You can consider a debt scheme of Aditya Birla to be switched out into.
Okay. Mr. Venkat, thanks very much. I hope that answers your query. The next question is from Mr. Adim Ali Sheikh Peer, and he's on the line with us from Madurai. Mr. Peer, good afternoon, sir. How can we help you?
Good afternoon. I've been investing with the Franklin Templeton Smaller Company Fund since 2017. In a phased manner, I've been scaling up my SIP amount.
Right.
My investment horizon is to the tune of 15 years. Is this a right way to do it? Can I continue with this for such a long time?
Okay, so Mr. Peer, one of course is that, never look at funds in isolation and always through your overall portfolio. But Shweta, quickly, we're out of time. What would be the recommendation for this particular fund?
Yes. So the Franklin Smaller Companies Fund, if you look at, small cap as a category from a return and a risk standpoint and compare it to, let's say a large cap category or mid cap category, the small cap category from a risk standpoint tend to have a standard deviation which would be in the range of 22-23% as compared to a risk level of 16% for large cap funds. From a return standpoint, the return differential is not much between a large cap and a small cap, with small cap an outperformance of, let's say, 1% over a longer time period. So when you look at the risk return trade-off, it works more in favor of large cap or multi-cap funds as against small cap funds. So this is a category that you should avoid. If you specifically look at the Franklin Smaller Companies Fund, if you've been doing an SIP for 2017, ideally, you would have lost your money here. So if you've been doing 1,000, 1,500 or 2,500 rupee SIP every month, you would have, probably invested 82,000, lost 3,000. If you had invested this in a large cap fund, you would have, gained 10,000. So both from a track record of this fund and the risk return trade-off between the large cap and the small cap category, my recommendation would be that you move out of this fund.
Shweta, thanks very much for joining in and for advising our viewers. And Mr. Peer, I hope that recommendation worked for you. We'll wind down on MF Corner. Do stay tuned. The news continues with the team of Closing Bell.